2,300%. That is how much a dying brick-and-mortar retailer's stock surged in a matter of days. Not because they reinvented their business model, not because of some miraculous spike in sales, but because an anonymous message board, utterly obsessed with internet memes, decided to completely bend Wall Street to its will.
Welcome back to Learning with Pratik. If you're new here, I try to increase neuroplasticity by exploring a new topic every day. I do all the reading and researching so you don't have to. Today, we're doing exactly that. We're decoding the hard data, the underlying culture, and the massive structural anomalies that drove the infamous GameStop short squeeze, and the subreddit at the center of it all, WallStreetBets.
Part 1. The meme stock anomaly and retail's market takeover. To really grasp this, we have to look past the sensational headlines and examine the actual mechanics of what went down in January 2021.
The SEC's own staff report reveals a surge that was just entirely unprecedented. Notice that massive, sudden spike. That is everyday individual accounts trading GameStop. On January 13th alone, the number of unique accounts trading the stock skyrocketed over six-fold compared to the very day before. The market was suddenly flooded with a sheer volume of capital that retail investors had literally never mustered before. But what actually lit the match? Well, the fuse was GameStop's short interest. Right before this insane run-up, short interest reached an astonishing 122.97% of the company's public float. Think about that for a second. More shares were shorted than actually existed to trade. It created the absolute perfect mathematical trap for hedge funds, a critical vulnerability that millions of everyday people sitting at home quickly identified.
Part 2. Anatomy of an ape, decoding the culture. Because, to understand the data, we first have to understand the chaotic, highly specialized ecosystem of WallStreetBets itself. It's a community that literally describes itself as, quote, like 4chan found a Bloomberg terminal. Let's break down their language.
It all starts with a stonk. It's just a goofy, self-deprecating mispronunciation of the word stock. But while it started as a joke to satirize terrible financial decisions, it perfectly captures their intentional disregard for traditional financial gravity. They weren't looking at price-to-earnings ratios, they were buying stonks.
Then you have diamond hands. This is a deeply held philosophy of absolute zero-flinch risk tolerance. It essentially means refusing to sell an investment no matter how massive the volatility gets or how deep the loss is cut. And here's the crazy part. This term morphed into a legitimate market force. Stubbornness, when you coordinated among millions of people, literally locked up the available shares.
And the ultimate goal? Tendies. It's slang for financial profits, originating from a bizarre internet joke about chicken tenders. It's wildly immature, sure, but it's somehow evolved into the legitimate battle cry for an entire generation of newly minted day traders trying to beat institutional hedge funds at their own game.
Part 3. The SEC autopsy and debunking the myths. Now, the absolutely crucial thing here is separating the internet lore from the hard, structural reality of the market. And the SEC meticulously outlined this in their post-mortem report. Let's look at the actual market plumbing.
Just look at the sheer volume of trades slamming into the market in late January. The entire system was fundamentally strained by millions of unpredictable microtransactions. We're talking about an enormous, unprecedented amount of retail flow being routed to off-exchange market makers. The basic infrastructure of the stock market was dealing with a sudden, hyper-localized earthquake.
And this brings us to a major misconception. The internet narrative heavily pushed this idea of a gamma squeeze, which is where market makers are forced to buy up a stock just to hedge against a massive influx of retail call options. But the reality? The SEC found absolutely zero evidence of a gamma squeeze driven by retail calls. In fact, the data shows everyday investors were primarily buying put options during the peak volatility. It was the market makers themselves who were actually buying the calls.
So the real mechanical breakdown wasn't some epic gamma squeeze. It was just a brutal breakdown in basic liquidity. As the price went to the moon, market makers stepped back to mitigate their own risk. This caused bid-ask spreads, which is basically the cost of executing a trade, to widen dramatically. At its peak, the nominal quoted spread for GameStop was nearly 50 times its normal average. The market was quite literally struggling to price in the chaos.
Part 4. The sentiment illusion, or predicting the unpredictable. Let's step into the cutting edge of financial research here and look at how artificial intelligence is attempting to predict these wild market swings using let-it sentiment. Can we actually quantify hype?
Researchers at the Wrocław University of Science and Technology discovered a really fascinating, counterintuitive reality. Advanced AI programmed to read text sentiment actually had incredibly weak predictive power, but simpler, blunt force metrics, like the sheer volume of comments or basic Google search trends, those acted as massive leading indicators. They had a very strong correlation to the stock price.
Even when these researchers went in and fine-tuned a machine learning model specifically to understand WallStreetBets slang, traditional text sentiment still totally failed to map to the stock's actual trajectory. You see that massive price spike? The text sentiment barely registers it. Words, as it turns out, are a surprisingly poor indicator of what retail traders are actually going to do with their money.
But here is the real mind-bending twist of the whole situation. While words failed, causality metrics prove that emojis actually speak louder than words. Seriously. The sheer volume of specific emojis, rocket ships, diamonds, and apes had a measurable, direct, and causal effect on market dynamics. Retail investors weren't typing out detailed paragraphs about their buying intent. They were communicating purely through high-frequency emoji use.
Part 5. Beating the banks and the new fundamental analysis. All of this data brings us to the ultimate billion-dollar question. Is this collective, emoji-driven chaos actually a viable investment strategy against the titans of Wall Street?
A massive, comprehensive study published on Archive analyzed over 1.6 million posts to see if Reddit could actually outstock-pick the seasoned professionals. And the results are pretty astonishing. The study concluded that, sure, not all WallStreetBets recommendations print money, but they achieve average returns that genuinely compete with the best banks. And in certain cases, they actually outperform them at detecting top-performing S&P 500 stocks. The crowdsourced due diligence of anonymous internet posters matched the world's top investment analysts.
So, I'll leave you with this question. Is social media sentiment the new fundamental analysis, or are we just looking at a temporary anomaly driven by a once-in-a-lifetime market condition? Let me know your thoughts down in the comments. Thanks for watching. Tomorrow, we open a different page. Until then, Pratik, out.